Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Wiesla Copper.
Will battery metals crunch? This is Paul Harris at the Precious Metals Summit in Zurich in Switzerland. And joining me to discuss this today is Andy Leyland, co-founder and managing director of Supply Chain Insights. Andy, welcome to Kitco.
Thank you, Paul.
Now, Andy, let's start off with who or what is Supply Chain Insights?
Yes, we're a specialist research and consultancy focused on the battery raw materials, going from mine through chemicals, electrodes and cell manufacturing. We do two main types of work. The first one is supporting due diligence processes, particularly when people are raising debt capital. So we effectively help the lenders understand the risks and the mitigants in putting billions of dollars into the supply chain. We then also do a lot of term sheet advisory. So a lot of the markets in battery materials don't really operate as commodities in the way that, say, gold and silver do. You can't sell them to a bank and get paid the next day. You need to qualify the materials. You need to know who you're selling to. And that means you need long-term take or pay offtake contracts. They come with a huge amount of risk, and we help companies structure those correctly.
The battery metal space moves at quite a pace. What are can you give us a recap of what for you have been some of the highlights of this year?
Yeah, so, if you go back to 2022, everybody was talking about the explosion in lithium pricing. That's obviously come off the boil, even though we're still at historically high levels. And what's happened there is, while demand growth is still very strong for the downstream electric vehicles and energy storage systems, which support, power from solar and wind generation, parts of the supply chain have moved into oversupply. So there's too much battery manufacturing capacity, there's too much cathode manufacturing capacity, in some cases there's too much chemical processing capacity. And what that's done is it's impacted the stock cycle, the inventory cycle. So you've had periods of destocking which have led to lower demand for lithium and lower prices. You've also had a bit more of a supply response on the lithium side, and while the market is still finely balanced, prices have come down, by 2/3 from what was astronomically high levels. From very much demand destruction levels down to a level where, you can still go out and buy an electric vehicle without paying $4,000 for the lithium in it.
Didn't something similar to this happen in 2018? The lithium prices went up really high and then came off really quickly. Is it similar to that, or is it different this time?
It's different this time. So what happened in 2018 is, demand was growing. Demand continued to grow, 20-25% a year. And you went from 22 to 32 operating assets. And it turned out we only needed 31 operating assets, markets being markets. That led to a 3-year price decline. And, it's probably crazy to say, as long as 3 years ago, we had lithium companies going bankrupt. Obviously, that curtailed investment in what we know is a growing market because you have this political mandate for the energy transition and, boom and bust cycle. I think what's different now is we're still in a very tight market. So prices haven't gone down to, below $10,000 per ton. We're still at $22,000. Everybody makes money at that level. If you can't make money at that level, you probably shouldn't be in this game anyway. So it's not as bad as people think, but it has had a negative impact on sentiment, and it certainly had a negative impact on equity valuations.
One of the things I've sort of picked up on over the last year or 18 months, the Western governments are finally or increasingly putting their money where their mouth is with different financial incentives aimed at different parts of the value chain to encourage the development of the broader battery infrastructure, but also the minerals supply to feed into that.
Yeah, in many respects, it's a bit of a beauty parade at the moment in trying to attract parts of this supply chain. Governments are realizing that they've made all these agreements for the energy transition that means zero emission vehicles. Lithium ion is the winning technology there, hands down. And if that political mandate means shutting car plants in Detroit and moving them to China, that's not acceptable. So what they've done with the Inflation Reduction Act in the US is they've said, okay, you need to have these jobs created in the US or in our free trade partner countries if you want to get access to subsidies. And we're also going to open up a lot of debt capital for you in the US, in particular through the Department of Energy Loan Program Office. That's helping. It's still difficult for the mining side because a lot of the funds available would rather focus on, chemical processes and manufacturing facilities and not extractive industries. And to be honest, there's still a skill set gap across the industries to understanding of extractive industries. In Europe, you still have, major investment banks moving away from extractive industries because they lump mining with oil and gas, and they say, look, we're not going to do oil and gas anymore. But they then also, they stop financing copper operations. There's still this disconnect, and I think we're going to talk a little bit more about that on the financing side and how it can be solved.
Absolutely. One of my questions is the money going to the right parts of the value chain? It seems that the money wants to go and build factories and ta-da, we're in production. But obviously that doesn't happen with mining. Mining doesn't move at those speeds. You've got that quite a long gestation period before you can turn the key and get some mineral out.
Yeah, and you hit the nail on the head. It's a huge problem that people say, yeah, I've got all this money, I want to invest in the energy transition. What have you got for me? I've got a cobalt mine in the Congo. Yeah, no thanks. And a lot of the money just isn't interested in that, but they are interested in employing parts of the supply chain that can be built quicker. So you can put a factory up in 2 to 3 years, whereas you're looking at 7 years plus, really realistically, for bringing a mine onto the market. Enter the critical minerals strategies. Now, you've been around a long time like myself, and every few years there's a new critical mineral strategy. There's nothing new there, and it normally is another talking shop. What we are seeing now is a bit more government money being deployed into the mining sector. The US has opened up quite a few tax credits. Canada's followed suit. Australia does a pretty solid job as it normally does. And some European governments are doing quite well. So if you look in Finland, for example, they spun out the Finnish Minerals Group, and they've brought some assets to market with more assets to come. So there is some success there on the government side, but governments aren't really enough to do this. What we need is another source of financing beyond the typical resource financing and beyond governments. And that's the end user, because it's the end user who ultimately suffers from higher commodity prices. If the lithium price quadruples, it's Tesla, General Motors, VW who pay that price. And they're starting to get a lot more involved in the sector.
One thing that occurs to me with, arguably the money's going to the wrong part of the value chain. I can recall seeing the images of the growth and development in China, where they're building all these vast estates of houses and they're all empty because nobody lives there yet, or the population's not there yet. And I have this vision of, you're going to be building these battery factories and EV factories in the US or Canada or wherever, and there's nothing to put in them because the minerals aren't there. It's good that governments are providing money and tax credits, but wouldn't government be better, their role be better to permit projects, to enable them to get into production, and perhaps get into production in a more expedited manner?
So there's 2 points there. The first one is, the role that governments play isn't going to ease everything up, and permitting isn't necessarily the problem. You need permits, you need environmental approvals. That's not necessarily a bad thing. The big problem that you often get are legal challenges to operations, and that can set you back, 6 to 12 months, or even longer. 6 to 12 years, yeah. And that can mean that your financing falls apart. So, or you go through a downturn in the market, and you no longer at the bottom of the cost curve. So, yeah, I think that the legal challenges and permitting need to be put together. You can simplify permitting processes. One of the things that we've seen success with, I think, is where governments actually take somebody from the bureaucracy and second them to a project for 6 to 12 months to actually walk them through what are quite often Byzantine processes in speeding up permitting.
I focus more on copper than on the critical metals, and certainly the US has a lot of copper potential, but pretty much all the projects are bogged down in permitting quagmire some way or another, which contributes to the situation that there's, are there not enough minerals and metals available to achieve the electrification and decarbonisation goals of government?
I mean, certainly there are geologically. So it's really an issue of timing and money. And I think the industry itself won't be able to meet those targets, or it will do it in a very bumpy way, because we work in these boom and bust cycles in commodity markets. So yeah, I mean, it's going to be tricky. As I say, I think it will be the end user who steps in. A lot of the automakers, very fresh in their mind, they had to stop production because they had a shortage of semiconductors. They can see that they're moving to a supply chain that they need to encourage to be built. They need to sign these long-term offtake contracts. They need to get their lithium purchasing. And, automotive manufacturers, they have battery purchasing teams. When I started going around automotive makers 5-6 years ago, the only person who'd see me would be the PGM buyer, because that was the only thing that they bought themselves. And then, it'd go back a couple of months later and there'd be, they'd have PGMs and battery materials on their business card. And then 6 months later, there'd be 4 of them. And then 6 months later, there'd be 20 of them in the room trying to buy these raw materials for their supply chain. And that's happening. They're not going to start operating mines. It's not their wheelhouse. It doesn't make sense for them. But investing in those operations, long-term offtakes, which help with the financing, particularly for debt capital, that's the way to go.
I'd like to sort of talk about the vehicles themselves now, because whether gas, diesel, electric powered, vehicle sizes continue to grow, which means they consume more materials, they consume more energy, presumably they emit more emissions in their production because of that. So why aren't governments putting more pressure on automakers or consumers to shrink the size of their vehicles?
So for batteries, one of the biggest problems that people have, or biggest barriers, are range and charging anxiety. And you get over that by having a longer range of the vehicle, which means a bigger battery, which is one of the reasons all of the electric vehicles are SUVs or hatchbacks that look like the size of SUVs. Now, it's a bit of an issue when it comes to parking them. And I think we were talking earlier, we're looking at buying another electric car, and the biggest thing that we look at is the width of the vehicle, because it's such a pain to get them into tiny parking spaces. But yeah, I mean, I think governments are not necessarily going to step in here. They do want to make sure that the materials are sourced environmentally. You've got things like the battery passport coming in that make sure of that. When there's enough charging infrastructure and people are a bit more happy with driving electric vehicles and they don't have that anxiety, they will be able to opt for smaller batteried vehicles that will be cheaper. And you may only get 200 miles of range from them, but you'll know that that's enough, because every time you stop, you can plug it in without a hassle.
Let's talk more about lithium now, Andy. More mines are coming on stream. The price has plummeted. Is lithium finally becoming a commodity like any other mineral?
Not quite yet, because you for something to be a commodity, you need to be able to exchange it with another version of that material. And you can't do that with battery grade chemicals yet. You can't do that with battery grade carbonate or battery grade hydroxide. You can to a degree with spodumene. So that's getting a bit more of a commoditization to it. But the specialty chemicals, you're another few years away before they have that full value in use confidence that they can source material from many different suppliers. And that will happen, partly because we're going to start losing provenance of where raw materials come from, because there'll be so much more recycled material coming into the supply chain.
Well, one of the big pieces of news in the space this week is Exxon, the big oil and gas company. They're getting into the business now with a DLE, direct lithium extraction project. I mean, that's quite a major step, isn't it, by a major global player coming from the energy space. Are we seeing a move from a mining paradigm for lithium to an oil and gas paradigm?
No, but partially when it comes to geothermal brines. Now, there are two things you need to do to run a successful DLE project based on geothermal brines. The first is well management. And, it's particularly when it comes to re-injection of the brine when we've taken out all of the goodies. That's something that Exxon are, world leaders at, experts at. And I think it makes a huge amount of sense for them to be involved. We've got proven reserves in the Smackover region in Arkansas, and they bought that license earlier this year, and they would have been planning it for quite a bit before that. Now their production target isn't until 2027, and that to me says that that's far enough away that they probably don't have all the answers yet to when it comes to direct lithium extraction, what technology they'll use, because DLE is a combination of technologies and the brines themselves are not consistent. So, you may have a brine with high levels of suspended solids in it, which is good for one technology to process, but not for another. So your DLE isn't one game changer. It's almost on an asset by asset basis. And Exxon, I think they're just putting their toe in the water.
Earlier this year, BHP, the large diversified miner, categorically said it's not going to get into lithium because it's not a big enough market for it.
Yeah.
Exxon is far bigger than BHP, so this isn't going to move the needle for them. So why are they bothering?
I think for a company like Exxon and some of the other oil majors have looked at this, they're just saying, well, look, it's a growth sector. Do we have skill sets which are deployable here? Potentially there's a little bit of window dressing or greenwashing, showing that we're doing something for the energy transition. But also, it can be reasonable return on the investment and potentially a foot into diversification away from oil and gas in many decades' time. Exxon have been quite forthright in saying they're an oil and gas company and they're going to stay an oil and gas company, and it's done their shareholders very well. On the BHP side, I think the lithium market it's not big enough for them, but for Exxon it's small enough that it really doesn't move the needle. So they can throw a couple of $1 billion away and nobody's going to bat an eyelid. BHP, they throw a couple of $1 billion away, they're going to have to answer some questions as to why they did that.
Fair enough. One other battery metal or mineral I'd like to sort of talk about briefly is graphite. Graphite dominated the supply, is dominated by China, particularly the spherical and spherical coated graphite that the lithium ion batteries need. There are deposits elsewhere, but it does seem that graphite is perhaps a critical overhang on the development of the battery space in the Western world.
Yeah, so you've got a few markets like this where effectively you've got an oversupply situation in China and an undersupply situation everywhere else. And it's very difficult to get financing in that market environment. People want your material. They want material that isn't, purely controlled by China and potentially a bottleneck in their supply chains, but they need to sort of figure out a way to pay for it. And say it doesn't operate as a pure commodity market. There isn't an accepted global price for the material. So, you end up having to go to your off-takers and come in with an agreement as to what a reasonable price will be.
Again, is this perhaps another area where the government should come in or can come in and fill in that gap to get from there to the ability to finance and give the financiers the information they need?
It's difficult for governments to come in and say, look, we're going to operate this almost as a nationalised industry because they don't have those skill sets.
Well, not necessarily as operating, but carrying the financial burden until you get to the point in time when the private sector can carry the financial burden.
And in some respects they do, particularly when it comes to debt capital and, you get export credit agencies involved and institutions like the European Investment Bank. That helps, or particularly in the US, the Department of Energy, they'll take up to 80% of the debt capital requirement. So, it's a huge amount of the financing potentially available. But it's still a challenge because, they want to make sure for the taxpayers that these assets are required, that they will make money, that they won't close after 2 years. So it's a challenge in, developing this non-China supply chain, particularly for graphite. Manganese would be another one as well.
What are some of the things you think we should be looking out for in 2024?
I think 2024, you are going to see a lot of negativity around the investments in the energy transition. And you're starting to see the energy transition being used as a bit of a political tool for electioneering. We're seeing that in the UK. You'll no doubt see it in the US election cycle as well. But underlying that, you're still going to see adoption of these vehicles. You're still going to see demand growth, and you're still going to see discrepancies in supply and demand develop. The one thing that we have relative certainty on is that the demand story is still there and it hasn't gone away. So it's really a supply side story. You'll have peaks and troughs, but I think that the overriding press will start getting a bit more negative and a bit more sort of us and them when it comes to these investments.
Interesting. Well, Andy, thank you very much for joining us today.
Thank you.
And this is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich, Switzerland. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Wiesla Copper.